All right, so you're listening to Avory Around the Desk podcast, where we dig into markets, companies, and ideas shaping what is coming next. Sean Emory here, founder, chief investment officer here at Avory and Company. It's a long time coming. I'm bringing on Garth Friesen. Garth is an investor, author, consultant, former hedge fund manager. He spent many years, I think 24 years at III Capital. He's also a Forbes contributor. He has a lot of good work there. We'll talk about that today. But really just covering, everything from markets to macro. Very successful career. We're so glad to have you on here. Before that, just for the sake of compliance, obviously, this conversation is for informational purposes only. Should not be considered investment advice. Please do your own research. Don't listen to either of us for investment decisions. So obviously, welcome to the show today.
Oh, it's good. After I was total about 30 years in the industry, started 4 years on the street. I worked at Merrill Lynch for a couple of years in London, was trading interest rate swaps. Then I was a proprietary trader for a while before going to the buy side. And then, as you mentioned, 24 years at the buy side. So it's nice to take a step back and not be on call all the time and watching markets to the same degree. But I'm still active investing, still do some, shorter term trading as well. So it's a nice balance these days, put it that way.
Good timing. The last several years have been, pretty dramatic in terms of what's happening in the world, both from a geopolitical standpoint, from a macro standpoint, from, the Fed, with that, the fastest rate cycle, on history, all of these, cross currents. People are questioning economic data and where it's coming from and how it's collected. Some of that is rather true in terms of the efficacy of what is coming from these data points, but a lot going on. So how are you, today thinking about the world from a macro lens with everything going on? We have a Fed meeting here, next month. You're still in the game, so I want to hear some thoughts.
Yeah, so I'm actually pretty constructive on the markets. Like I think everybody, we really didn't know what direction we were going to come out of the pandemic and the ultra low interest rate cycle. But despite the damage that was done to the housing sector and to the tech sector after those rates started to go up by, 500 basis points, look, we're back into a normal macro environment with normal cycles. Like we're looking at valuations on the equity side that are a little bit steep if you're looking at the US only, but the rest of the world where multiples are much more close to their historical averages, I don't think we're in a bubble type scenario. And then when you're looking at the tailwinds that we have behind us with inflation coming down, yes, there's still some concerns about the impact of tariffs and what's going to feed into it. But I think the overall, if you look at it not on a trying to get rid of the noise, look at it at a bigger picture, I think we're going to be stable to maybe a little bit higher inflation over the next 2 or 3 years. But there's still room with the Fed to embark on its easing cycle, which the market's got priced in, roughly 150 basis points over the next 12 to 18 months. So I think all these things are going to continually feed into the positive narrative. I think you've got a lot of other opportunities in asset classes as well. It's not just about equities, obviously. We're looking at real rates, which are at pretty attractive levels for bond investors. And then when you're looking on the private market side, you have plenty of good opportunities there. So overall, from a risk perspective, I'm pretty positive. Obviously, there are trades to do around this environment, but from a general theme, I think there's still more tailwinds to come from this big technological boom that we're in right now. Obviously, there's some labor market issues, but I'm sure we'll get into that. Overall, I'm pretty positive. I'd be on a scale of 1 to 10, I'd probably be 7 bullish.
Yeah, I mean, it can never be too bullish. I think if we all say a 10 at some point, there's maybe some, we're maybe over euphoric at that point. But we could end this, call there. I think we're both bullish, so we turn it off and move on to the next one. No, but, obviously April, with the tariff stuff was, rather shocking in terms of, the magnitude of tariffs. Maybe let's go back to, your thoughts at that moment in time. Like, how are you, dissecting the situation? We did our own work here and, trying to figure out, the path of, what path, the administration was truly trying to take there. Sure was, this is either something where they're trying to, isolate the U.S., that's, option number one. It's, whether you're trying to be a negotiation tactic, option number two. Or three, which is really a combination of both, which is, bringing back, some trade and manufacturing here while also, trying to increase, some of the revenue that's, coming to the States and using that kind of as a tool. But like, go back to April. How are you thinking about this, more broadly? And, I've read, your piece in July and how you're thinking about the market on a go forward basis. But I definitely want to go a little bit, earlier than that.
Yeah, look, I don't think anybody really saw the extent of what happened in April coming. And when you're talking about what was, we spent a lot of time as analysts and watching the market of what are these tariffs for? Are they revenue? Are they about just negotiating tactics, as you point out? Is it both of them? And I'm not sure if they necessarily know either. Uh, and I was really surprised with the degree of the liberation tariffs that came out or on Liberation Day. But I was even more surprised of how quickly the market rebounded from the lows and the implications. Like, look, these markets, you've been in the markets a long time, like they're pretty smart, right? They can figure things out. And, you know, I don't believe that these tariffs are not a tax. They're clearly a tax. I think the government's estimating raising what I think 400 billion next year just from these tariffs. But I don't think we're going to know. It's still too early to know definitively who's going to bear the cost of that. And so when you're trying to think of the macro implications, like if you knew definitively it was going to be US corporations, you could start to build that into the earnings, but you don't really know. And I think it's going to take some time to figure that out. And I think the biggest implication is for inflation and what happens. We talked a little bit about that. How do you factor that in? I don't think necessarily the price increases get absorbed by the companies. And as the pass through takes place, it could happen over months, could happen over years, even the pass through. So we're not going to see a one time adjustment in inflation where we can say, okay, now we know the full implications. It's going to take some time. But it's more than just economics. Like what this does to global supply chains, what this does to alliances between countries, trade relationships, nearshoring, all these things are still we don't have the answers to. But it does seem though, even as let's operate that the tariffs are in some sense a drag on the economy, which I think most people would agree that at least they are in the short term. I think the market has benefited from some of the other actions from the government where I think the government knows it too, the administration knows it, and with the one big beautiful bill trying to offset some of those negative impacts when you look at what they're trying to do with bringing back manufacturing, a lot of the tax incentives that were in that bill. So I think the market, managed to look through the worst case scenario, but we still don't really know the implications. I think it's too early.
Yeah, certainly too early, given that there was multiple delays, and I think one thing that the market has confidence in is Bessent is in the seat, and therefore understands markets. Markets can break, should you continue to press, and therefore the obvious rumblings post the tariff announcements was two individuals to step aside and Bessent kind of be front facing and articulating the message clearly. I think that partially gave some solace to investors broadly, given that they're all affiliated with the investment firms, and we kind of took that stance, right, where you have to always look at incentives, and the incentives across the cabinet, ones making trades, are all somewhat connected to the financial system one way or another, whether it's colleagues, ownership of firms, and therefore there is this incentive to ensure that things don't quite break. Otherwise, on a politics side, people aren't going to like you, but then also beyond that, you're talking about personal lives that probably could change as well. So in the back of my mind, I'm always thinking about that. What are the incentives of these individuals outside of just, policy and politics?
Wasn't it?
Yeah, go for it.
I was going to say, wasn't it interesting though that when we were in the depths of April, and we weren't sure whether the tariffs were going to stay or the Liberation Day rates were going to stay, that as soon as we got that delay and we're going to postpone them till at that point it was till August, that's what really set the market rebounding. But when you look at what was advertised versus what we actually have now, in some cases, it's even higher than what was advertised on Liberation Day. And the market has just brushed that off. So, in some sense, it was just maybe a time adjustment that the market needed as opposed to the level of tariffs coming
Sure.
down because they're not really that much lower than the Liberation Day the way they were advertised.
Yeah, definitely in aggregate. I think many of the numbers are maybe a smidge below what was on that board that day. One thing too is though, you mentioned it months or years, our view is mostly this is happening in phases, where the phase isn't necessarily how they're issuing it, it's more the inventory build that takes place, which is we had the first announcement, that got delayed, but on that first announcement, many of the manufacturers and wholesalers that are selling, call it department stores and such, they're front loading, right? So they front load,
Mhm.
maybe they're getting ready for the summer season or the holiday season. And that's the thing, there's seasonal aspects to some of these goods that are being purchased. So anyone that was near term, was buying their inventory ahead of time. Then obviously we get the delay. So then you have another wave or a period, a gap where, inventory can be bought at, certain levels and rates. You have probably like half, a third of all the purchasing that would have happened at lower rates. So our view is that this price build, like you mentioned, has to be eaten by somebody. And therefore, it's likely going to be here in a form of a tax. But if it happens over 24 months versus 3-4 months, it's a big difference psychologically to the consumer if I'm getting incremental raises over the next 2 years at a 2 to 3% clip versus a whole 6-7% clip. Then the question, circle back and tell me how you're thinking about it, where you'll have the end seller selling to the consumer. That merchant decides, do I keep gross profit dollars or do I keep gross profit margin? Private and public companies alike, therefore, the actual burden of the tariff can be reduced roughly by half, depending on the starting gross margin and gross profit dollar. But we just did rough calculations, and you can get to a place where it's a 6% lift in cost of goods sold spread over 2 years, which again would only be a 2 to 3% lift over that time frame. So that's kind of like, what's your thoughts overall on that kind of concept?
Yeah, it's going to depend on the industry. It's going to depend on the companies in that industry and their own strength. You could just take an industry, for example, that's been in the news that's particularly vulnerable, with Switzerland, the Swiss watches, right? 39% tariff, I believe it is, on Switzerland. As you pointed out, a lot of the big manufacturers front loaded inventory into the US, where they had this, they were doing that March, April, and then they had the opportunity after April. And so what happens when that inventory wears off? And I think this is where the markets are pretty smart, and maybe there will be workarounds and coming in through different channels. There may be some pricing manipulation that takes place with companies in terms of how they sell into the US and where that company's overall margin lies. Do they leave some margin in Switzerland? Do they leave more margin in the US? It's a very complicated situation, but the implications of having the prices leak into the consumer over a period of time, over 24 months versus a one-off hit, is this is going to complicate things for the Fed that's already in a bit of a pickle with respect to its view on inflation and on tariffs. Like you look at just inflation, and the Fed isn't necessarily supposed to be easy. We're still not at core level or at target. It's been drifting higher. And if we get this steady leakage into the CPI and into the PPI over the next 24 months, it's going to be difficult to isolate it as just the one-off adjustment or the one-off period of time of adjustments versus what they view as really persistent inflation. So, the benefit is that it'll give chance for businesses and consumers to adapt. The cost is by having it slowly leak into the economy in terms of prices, is that it could prevent the Fed from easing as quickly as it would otherwise if it got the confidence that these were just one-off adjustments that we could point to and say, that's the tariff. It's just, unfortunately, not that easy to do.
Yeah, no, for sure. Speaking of the Fed, obviously we're coming here to what looks like the start of a progressive easing cycle. At least that's what the market is pricing in today. I think as we speak right now, 150 basis points roughly over the next 12 months. That seems a little aggressive outside of a cascading jobs market and or a sharp reduction in inflation. I do think the easing is somewhat warranted just to prevent things that are happening in the jobs market, reduce the cost of capital. That could help alleviate some of the pressures and concerns. What's your thoughts heading into, not necessarily next week, but more so, the next 12 months as you think about the Fed and kind of its mandate?
Yeah, so we know the Fed's mandate, right? It's the dual aspect of employment and price stability. And on the price stability side, if you're just isolating that, there's not really room for them to be easing aggressively, certainly not the 150 basis points that's priced into the market. But if you look at the employment side, that's clearly there is weakness. And you mentioned it earlier about the quality of the data. Like, how do you even, if you're data dependent and you're looking at data that's being revised by incredibly massive amounts, how do you ascertain that and build that into your forecast? But I think most people would agree that the labor market is weakening. You're seeing it in The not just in the rise in the unemployment number, but you're looking at quits, you're looking at hires, you're looking at layoffs, you're looking at the payrolls. There's a lot of indicators that show that it's weakening. The question is, can the Fed ease based on employment when the inflation side is still sticky? And I think the answer is yes. I do think 150 is a little bit optimistic for the market right now. Personally, I'm a little bit short 2-year notes at these levels, just as a play that I think most of the good news for the easing is priced in. I don't think there's really a chance that they go 50 later this month. I just see some people viewing this as an emergency, but I don't think the Fed under Powell views this as an emergency. I don't think they even really want to cut that badly, to be honest. But I think they are feeling the pressure, not the political pressure, but the market pressure to do this. It's a little bit in violation of their own data dependency, which by nature is going to make them late. I do think they will start easing, and it's too early to tell where it ends, but I do think the market's a little bit aggressive in pricing in the level of the terminal rate right now where it's being priced. What is it, around 3%?
Yeah, yeah, around there.
Yeah.
Now, the one thing that I found interesting, we talked about jobs data being, somewhat a little less certain with many of the revisions going back. Now, if you look at I made a post about this recently or today around the computation, how the CPI is calculated, and actually, I think at this point, 68% of the data coming through is just basically carrying over from months prior, as opposed to the survey data, which I find to be quite shocking, right? When we're talking about arguably the most important decisions for macro, therefore the broad global economy. How do you think of that? So like we sit here and we try to track, some of the more real-time pricing mechanics of inflation, and that is, again, it's not a perfect science. Everything's going to have its flaws to some degree. That, take an index like the True Inflation Index, which has many more data points, constructed in the same way CPI in terms of basket size, but scraping real-time data looks more close to 2%. That's what it's tracking at. And then again, you have the idea that many of these data points for CPI are just simply being carried over, which is kind of shocking given that we're sitting here talking about tariffs, which, do they have a quick shock, which carrying over last month or carrying over the month before, could be pretty detrimental to the outcome of what you believe that data is telling you. We've seen over the last 5 years, COVID, it was a quick shock for the most part. And therefore, if you're just using imputed prices from prior, I think you can miss either the ramp up or the ramp down by several months at the very least. What's your thoughts on that? Obviously the Fed's going to look at the data that they use, and that's part of the circular problem is you have Wall Street essentially focused on some of this data, these government data points for the most part, still using alternative data sets to make their own informed decisions, but they have to provide a number, right, for CPI, for estimates. Then that flows into, the investment side. So it's kind of like this full life cycle where, the Fed's using it, Wall Street has to use it, and therefore, that cycle kind of repeats itself unless the head of the snake cuts it out and changes. But is this the moment to change? Is this really that moment to, start using different data sets than we have in the past? And just thoughts around that, right? There's questions about data sets and what's right and what's not, and where are we actually, and maybe why is the Fed always so late? It could be many of these outcomes and inputs that they're receiving. Just any thoughts around those things? Are you using real time data? Stuff like that.
No, I don't think real-time data has its flaws as well, right? And
For
its
sure.
noise, and it's vulnerable for correction too. So, CPI calculation hasn't really changed over the years. The BLS calculation of the way it collects its data, the methodology hasn't changed, although the inputs have gotten a little worse in terms of the amount of participation they're getting. So there definitely could be some adjustments there for improvement. But if you're the Fed, all you've got is the existing set of data, right? And CPI's had its lags. It always has had its lags. Like just take a look at housing, for example, where it's based on the total stock change in price of the total stock of housing, not necessarily the change in new rents that are being calculated in the market or new tenant rents. And when you're having situations like in COVID where rents are rapidly increasing, and then you have in other parts of the country rents rapidly decreasing, in the situation like we're in now, there's going to be that lag inherent in the lag. And so in defense of the Fed a little bit, Like, what else are they supposed to do? This is why they are looking, they always say they're looking at the totality of the data and waiting for confirmation. Part of that is, I think, a recognition that the data is noisy and the data is vulnerable to change. And so, this is the one thing that I've always wondered is like, as an investor, not necessarily as a trader, but as an investor, does it really matter whether the Fed is a month or two late? Like, it shouldn't, right? Like, if you're really looking at cycles, are they hiking? Are they easing? Or are they stable? Like, I think the market and traders get way too uptight about trying to get the timing right. And whereas if you just get the cycle right, then, I think that's an investable theme. If you're trying to make the timing of they're a month late or, 2 months late, right, I just don't think that has, from an investment perspective, uh, really, I don't think it really matters. What really matters is, are they easing or are they going to stay tight or are they going to stay neutral?
Sure. I guess how then do you think of like those turning points, right? Because if these next, so jobs in theory over the last 6 to 12 months have been virtually zero, and therefore the margin of error is now shrinking. Let's say from the standpoint you're kind of on a ledge. If you get some sort of random shock, I don't see any shocks in the system currently unless we go back to April type of mentality and it all gets hammered down. But those, first off, I'm agreement. Long term, we're long term fundamental investors, so like I'm clearly trying to be part of cycles as opposed to that. But I can also see where some are trying to catch those turning points, because if we're eased now and the macro stays fairly stable, that's your 7.5 or whatever probably goes to a 9.5 if we execute that that shift properly. But there's also the risk that let's say next week they say 25 and they kind of say, hey, we're on hold for now. We need more to see. Obviously, on the back of our minds is, Trump is clearly trying to get somebody at the helm that is going to facilitate cuts. So that's kind of like this, side positive, I guess, for anyone that is trying to think the next cycle is here upon us from a macro perspective. So I can see, I guess, where that moment in time at the cycle transition period, specifically right now, let's say, just because it's kind of been on and off, over the last 2-3 years, there is some fragility. I'm constructive, we're bullish. I agree wholeheartedly with you, but I can see the other side where, these little moment in times, the margin of error starts to shrink. And the question is, are they going to be late? Therefore, the negative of this cycle will be deeper than anticipated. Therefore, the rise could take a little bit longer to initiate. Again, we don't think in that lens, but I'm just throwing the counter to a little bit of that concept.
Yeah, and that's the criticism of Powell, right? Like, other Fed chairmen have been able to incorporate a strategic view of the economy into their cutting cycle or into their hiking cycles, right? And as much as they were data driven, they were still incorporating their core view into setting policy. And Powell tried that, right? He tried that during COVID with the inflation being transitory, and he was clearly wrong, and inflation went to 9%. And so that's when they really doubled down on the data dependency, with the recognition that nobody has perfect data. Even the Fed with its army of 100 PhDs, right? They're not that much better at predicting things than us or other economists or other market pundits. So, I think it's developed just by experience for him that he can't afford or doesn't want to have to go through another scenario where he's making a market call and is wrong. That's like when you're saying that the risk of being late is a real risk, and maybe you're delayed, and maybe the economy could get some relief a little earlier than it would, preventing a worse downturn. But the risk of having somebody take a view on which direction to go before we get the data confirmation is that he's wrong. And so when you pick the, which of the two do you want? I think that, overall, you're probably better off having a Fed that's a couple months late than a Fed that is wrong and has to reverse course. One is timing and one is direction. And I think I'd rather have Powell
Direction.
just be a little more conservative on the timing. But yeah, no, and is it really that big of an issue? Like, and the question of being late is like, we recognize the job market's not great. I think we also recognize that the inflation environment isn't flashing green to ease. Now, if we were seeing growth really deteriorate at this stage showing up in the data, then I would say he's arguably late because growth is inherently a lagging indicator. It shows up in a lot of other places before it hits growth. But growth is actually still okay now when you're looking at projections of Atlanta GDP, you're looking at the actual numbers, you're looking at earnings, which are still really strong at a fundamental level. So, the coincident or the leading indicators are not saying that growth's a problem. I just think there's not the sense of urgency that the Fed has. I don't even think the market has that much of a sense of urgency where if it's not quite on the path that is projected as far as easings go, I think the market can live with that, long as the
Yeah.
direction is right.
Yeah. And also, again, going back to the idea that this administration is going to put someone that is biased at some point here in the next 6 months, regardless to some degree. Obviously, it's a whole committee, so people have to make real fundamental decisions there, and everyone has to somewhat agree. But you will have someone at the helm that is likely more cut focused. I would say with a 90% certainty that individual is going to be more inclined to cut, given that it's likely the mandate to some degree.
Well, that's one of the big issues. Just staying on that for 1 second, though, is if you
Yeah.
get a Fed in there that has a mandate or not necessarily a mandate, but has a inclination to cut a little bit earlier than expected, like, is this really going to bring down long rates, right? Like, the economy doesn't function off Fed funds. The economy functions off
10-year, yeah.
10-year rates and mortgage rates for whether it's discounting, whether it's setting lending rates. So if you have if the market smells a Fed that is overly aggressive in its easing, yeah, you can get short rates down because that's what they control, but they don't control the long end. And you're already starting to see super steep curves in the US, but you're also seeing steep curves everywhere else. You're seeing the back end of the UK hitting historical highs. You're seeing Japanese 30-year rates continue to weaken. So there's something going on in the back ends of these yield curves globally in other G7 economies. Some of that may be in anticipation that the Fed is, on course to start easing prematurely in a new or having a cycle that is a little bit premature in a new Fed regime. But it's also hard to explain why you're getting these steep curves everywhere else as well. So
Right.
it's difficult to isolate the implications of a Fed that's too early or too late, or a Fed that's changing its, not mandate, but changing its approach to monetary policy.
Yeah, I think that takes us to real estate. You wrote in one of your Forbes articles around real estate. We're actually very constructive on a go-forward basis. Again, cycles, right? 36 months, 48 months out, more so than the next 6 months. Transaction volumes are sitting here at bottom of the cycle lows, 3.9, 4.2 existing home sales volume. The implications of that on jobs, the implications of that on construction, not new construction, but existing homes, mortgage brokers, agents, all that is a pretty big ecosystem. Some calculate it to 10% of a lot of GDP, let's say, but I think it spans much broader than that. If you start to say what's the implications of that on restaurants and many of the other second order, third order effects of real estate. But I wanted to let you share your point of view. I think you had not only rates and kind of like cycle, but also the big, beautiful bill that was recently put in place. So I just want to leave it to you to, why are you so constructive on real estate going forward?
Yeah, so I think it's important to separate real estate markets, like real estate, into a couple different categories: residential real estate and commercial real estate. My thoughts on the residential real estate market is that it will clearly benefit from the unlocking of mortgage rates low with some increased flow and transaction if mortgage rates do come down over the course of the next 6 to 12 months. But we're also dealing with a market that's very expensive there. I mean, you're starting to see some adjustments in other cities. The ratio of rent to own is still way out of whack in favor of renting across the country, except for, I think it was Pittsburgh. I saw some data. So if you want to move to Pittsburgh, maybe that's the place where it's cheaper to buy than to rent. But in the majority of cities, you're still, the economics are clearly favoring renting. But I think a lot of what the big, beautiful bill was targeting was on the commercial side. And I think that's where there's some pretty interesting opportunities. It's not just what it can do if we can maintain solid growth in the economy, but whether it's the low income tax credit that was introduced, fast track permitting, opportunity zones. And I think the biggest surprise with the qualified production property, where you can get these accelerated 100% write-offs in production property, all that, along with the administration's policy of trying to reshore and providing deals and incentives with whether it's the tariffs or whether it's public-private partnerships to bring business back into the US. I think the industrial sector is probably going to have a lot of good tailwinds, but I also really like the multifamily sector as well, where you're looking at cap rates now of probably 5.25 range for Class A properties, depending on where you are. And I think there's a lot of room for that to compress if we get mortgage rates down. And multifamily, other than some of the other subsectors of commercial real estate, whether it's office or hotels, you're not really that sensitive to the economic cycle as much as you're sensitive to demographic movements. And so if you can pick locations where there are definitely still demographic movements taking place, a lot of it along tax lines, people, I'm based in Florida, talking to some people, they think, oh, if Mondani wins in New York, there's going to be another wave of businesses and people moving to Florida. Along the Sun Belt, we've been seeing that since COVID in these areas where there still is an influx of population and you have higher cap rates to start with on multifamily type properties. I think that you're not necessarily, even in a downturn, you're not going to see a major drop in vacancies, which are in the 94-95% range, um, especially when you have that purchase to rent ratio that's way favoring renting. There's a lot of tailwinds behind that market. And so I think for new capital, it's a pretty good place, I think, to invest over the next 5-10 years.
Yeah, that's pretty interesting. West Palm, Boca, I think, are pretty hot spots for large buildings.
And a lot of the supply is not just the supply of multifamily now is balancing as well. Like over a lot of new constructions was started in 2021 when rates were zero, money was free. A lot of those new buildings came to market last year. They're still coming, but at a much lower pace. But looking forward to 2026, you don't have nearly as much supply coming, and the absorption rates can get, I think, even better, which is another, just another supportive tailwind for multifamily.
Yeah, I mean, the way we're playing some of that too is, everyone loves asset light businesses. Obviously, you're a little bit more nimble in the phases of, different cycles for sure. And then obviously, your margins and profits can be somewhat exponential depending on the area and adjacencies that you're in. But we've been leaning more into kind of these more asset heavy, in the last 4 or 5 months as we prepare, right? Very similar to our prior conversation here was prepare for an easing cycle of sorts. And then you add in, some of the characteristics of the big, beautiful bill. You get, some of these companies that are doing now sale leasebacks and you wait till after. So now the value of that sale leaseback is a little bit more attractive with some of the different policies that are in the big, beautiful bill. So they're getting, a little bit higher or a little tighter cap rates when they sell this back and then, take tenancy. So that's pretty interesting.
Yeah,
Now,
when you look at that, like, asset heavy is capital heavy. Capital heavy requires financing and investment. The financing rates come down, that should be a tailwind. And then when you throw in the bonus depreciation, I do
it's a
agree that that's
multiplier, yeah.
probably, a good multiplier. You get it on both sides.
Yeah, for sure. And even some of these places, a lot was built out in 2021, like you mentioned, depending on the industry and sectors. And, a lot of that was with cheap capital that people brought on floating rates just before the rate hike. Some of these industries faced private equity stepping in, weren't necessarily operators, more financiers. And therefore, we're 3, 4, 5 years away from that. And what you're seeing in some industries, whether it's restaurants or car washes and stuff like that, that are much more heavy lift, many of those non-operating finance-only purchasers have failed to execute given that rates plus operations went a different direction. And therefore, it's opening up that opportunity for the leaders in those categories to have lower cost of capital going forward, both from the market and top down, but also given that they're self-funding, they're just in a better credit position to go to a bank or private credit to seek more attractive rates. So you're seeing that, everywhere too. I mean, some companies now, we're seeing it more and more again. It kind of reminds me a little bit of, I don't want to say, 2021 timeframe, 2020, where you're seeing more and more, convertible debt come to market, with zero interest, with 100%, cap upside, before that converts. And you're like, that's pretty cheap capital right there and pretty big check. So next, thing I wanted to talk about was, AI technology. How does that fit into your equation, both on the investment side, like how are you thinking about it, number one, and then, I think I love to, learn from, anyone out there that's using it in any sort of, creative way, are you using it, So anyways, we'll just start with the investment side of AI. How are you thinking about it?
Well, it's clearly real, right? It's not, this is not just a bubble. There's real investment taking place. There's real technologies. There's real businesses that are being built on it because the benefits are real as well. It's only now that we're starting to see companies not just talk about the implications of AI in their business, whether it comes to the number of people that they're hiring on the technology side or on the efficiencies they're getting in their marketing and sales groups. But they're now starting to attribute margin expansion to benefits of AI. And so it's real, it's not going away. Are the hyperscalers that are investing, what's the number now? 300 billion this year alone in data centers. Are they going to get the type of return on equity that allows them to continue the high double digit or high teens types earnings growth? Maybe, maybe not, but AI transcends just the hyperscalers. You're seeing it has implications for the energy companies. It has implications for obviously the chip makers, for manufacturing and the build out of these data centers. Uh, so it's a real technology that I think is what will continue to drive earnings and the discussion over the next 3 or 4 years. So I'm a big believer in it. And, to answer your question about personally, yeah, I don't know who doesn't use AI right now, right? Like
It's a
everybody,
good point.
I'm in a bunch of different groups, like what everybody I think has Chat GPT. I use it for a lot of different things. I also, as a writer, I use it for screening ideas and finding information on a topic. Perplexity is one that I particularly like. Perplexity AI, just because I think the sourcing of the articles that it has is a little bit better. And not just the sourcing, but the attribution to the data that it's giving you. It tells you exactly where it's at. So as a writer, if I want to write an article on Jerome Powell at the Fed, I can type into Perplexity is get me every quote in the last 30 days from the FOMC on the topic of the economy or on Fed rates. And just boom, 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 boom. It lays out exactly who said what, where to get that data. So, from a research perspective, it's really cut down the amount of time to locate information and to incorporate it. Now, I think those are the use cases for writers, but there's use cases everywhere, and not just for Perplexity and ChatGPT. I've been playing around with the new trading software in the last couple of weeks. Are you familiar with TrendSpider?
Yeah, for sure.
So I've downloaded one of I think you have to have a little bit of the premium version to use it, but some of the AI tools in that software are incredible from an investing trading perspective. It will give you it'll back automatically. I'm not sure if this is necessarily AI as much as it is, machine learning. Some of it's obviously machine learning, which has been around for a while, but the back testing capabilities are tremendous. Like you can put a hypothetical strategy in, and it'll give you back your percent wins, percent losses, the net gains, net losses, average wins. But on top of that, then you can go into the AI and say, what can I do to improve the strategy?
Mm.
It'll come back with a lot of data on, well, maybe you need to use a different set of moving averages in your indicator. Maybe you can reduce the downside capture by incorporating these strategies. So it's really incredible. And I'm sure there's other software packages out there that do that, but like, what does this do for the analysts of the world, right? Like, does it decrease the need for analysts, or does it just change what the role has to be in terms of being able to, identify what's real, what's not, and, double checking work as opposed to creating it in the first place? I
It's
don't know.
probably
It's pretty spectacular.
Yeah, it's probably a little bit of both, right? The way I think about it is, if you can be more productive, you hire more productive people. And yes, the role may shift a little bit, but it's, hey, now you have, let's say you're a quant shop, right? You have two analysts that are backtesting 50 different things now, as opposed to, spending all that time in whether it's, Python or an Excel spreadsheet trying to find one. So now you have more people experimenting more in theory, right? I think if you're smart and you're looking for like and you're focused on ROI, like I think that's ultimately where it leads. You're hearing many of these companies, specific on the Salesforce side, like sales practitioners, part of companies, it's obviously making them more productive, and therefore, they can take on more leads at one given time, and whether conversion goes up or conversion goes down, you're just getting more people in the funnel and then taking them to delivery or execution of closing a deal. You're hearing many companies shift a little bit of maybe their software engineers to year, and then there's their their sales reps, they're increasing sales reps because they can be much more productive and there's a clear ROI on a sales rep. And so I think that's probably how it's going to be in the investment world. I think, at this stage, people are still trying to figure out. So the chat bots, support bots, that's all the obvious stuff. The writing, creative, very much obvious stuff today. It wasn't so obvious, obviously, 3-4 years ago, but it's a very obvious use case. In the finance world, I think, like you mentioned, it's, what will people do? I think just eventually it's going to come down to people are more productive. So you want more productive people and therefore, the productivity inside your business goes up. That's my feel, at least for now, rumblings of it.
Do you use it to help with analytics of a company if you wanted to do a deep dive into Walmart or something and you ask ChatGPT or whatever language model you wanted to use to come back and get data? Have you found that data to be accurate, or do you look at it just as you don't take it word for word or number by number? Do you just look at it overall? Because I've had experiences where there's definitely been hallucinations where
Definitely, yeah.
I get back data and I ask for more information on this, and it's just completely wrong. Like quotes attributed to people that they've never made, so it's not perfect. So I'm just curious of what your experience has been on the finance side and pulling hard data and numbers with respect to a company, if you've done that.
Yeah, so I mean, definitely we try to, especially early on, was trying to see, I'd have a company report. I would say, hey, they just reported, tell me, how they did. And you would get wrong numbers and you're like, well, I can't trust this because, my opinion can't be based off of hallucinations on the report. So, definitely, much of that is still by hand to some degree. Now, if you can structure it in a way where you have some of the data sets where, let's say you're pulling it from, the Bloomberg API into your Excel, and then you're taking that, then uploading that, so the data is exactly how you want it, then that's how you can kind of refine it to make the process a little bit more smooth versus relying it to jump on the internet and scrape their investor relations page and synthesize it. But I'd say more synthesizing, and then also in those areas where I think it's really, really important, not relying on it, at least as of now. Now, there's some of these platforms out there that are trying to remove some of that, and they're building their own kind of like backends that are all structured data or structuring the unstructured data, then obviously being very verticalized to the finance space to make sure any of the data points that are being pulled aren't these unstructured websites where things are just coming from all different places. So I agree completely. I would never rely, at least yet, on any of that stuff, but I think we'll eventually get there. At the end of the day, structure it.
Yeah, we're definitely going there. Have you played around with Notebook LM?
I have,
Google's?
yeah.
So I haven't used it for data or for numbers, but I've used it for researching articles where exactly what you're trying to talk about, the nature of making sure that the inputs or the data that you're using, you trust, whether it's from Bloomberg or from other source. But with Notebook, I just loaded in maybe a dozen. I was writing a report on, I think it was last year, China came out with this new stimulus and whether it was going to work or not. And there was a lot of questions on it. And I uploaded into Notebook LM a handful of articles from trusted sources that I wanted, like whether it's foreign policy or foreign affairs or the Hoover Institute or, articles academic related or from publications where I felt that I could trust the data. And from there, I could interact with the language modeling, get answers, and that I felt had a little more integrity rather than, like you say, just going to the internet, finding data from somebody's blog who wrote something that is providing information without any backup for it.
Yeah, I mean, that's,
So
I
there
think,
are ways of dealing with it.
yeah, there's definitely ways to put guardrails to some degree and making sure it's useful. And even there, like you can kind of recheck it and just make sure, we're investing in companies, right? So we typically, and we only have a handful, like 12 companies, right? So I have a pretty good grip of like what's happening there. You listen to the earnings call and then, you're trying to synthesize it for note-taking purposes later on. And, you kind of know, generally speaking. So it speeds up the process still, even if it hallucinates a little bit, as long as, again, what you're putting in there, it's not decision-making. You're not like saying, hey, should I trade today? Should I trade tomorrow? Should I buy this? Should I sell this? I think all that is still going to be, brunt work from the, humans, let's say, today. And then eventually, we'll see. We're trying to build some stuff. We're using some of those vibe coding tools like Replit and other stuff to build interesting dashboards. It's pretty wild how far you can take that. So I think that's going to be more and more of a tool that you can self-create your own tools. I think we've all wanted to have our own dashboards, our own software, our own capabilities And yet, it was a big lift 5, 10 years ago. And that lift is getting lighter and lighter. But yeah, no, AI, agree, it's real. We'll see what happens, over the next decade, really, is how you should think about it. But, we have a couple more minutes here. But I definitely wanted to, number one, last thing is just, you've been doing this for a long time. And, I think one takeaway I want, listeners is, someone that's done this very, very successfully. One thing you've learned, some advice that you'd give, someone listening in, whether it's, someone that is about to retire and, they've had a successful career, or, someone getting into the game today.
Oh, so those are, yeah, a couple different questions, right? Of, advice. I definitely have advice for people who are about to retire and what to do with their finances. But, I also have different advice for people who are just getting into the game. I mentor a lot of college level students that are trying to get into finance, and I, have one-on-ones with them, and I help them trying to figure out their edge when it comes to competing and getting some of these top jobs. And yeah, it's hard, right? You got to be really in it. You have to really be paying attention. You have to be passionate about markets. But, as far as maybe some advice, because this is something that I just went through and I've seen some of my other friends and peers go through of when they retire, is that they've had a tendency to think that had a very successful career, you know, maybe maybe in the markets, for example. It doesn't have to be in the markets. It could be in a different field. But that success has led them to believe that they're going to be equally good at the next thing that they try to do, or equally good at the next business that they're going to try to operate in retirement. And I've seen it happen a few different times where uh, people retire, they think they're going to be fine, they've done all their financial plan, they're not going to be working anymore, and then they just don't diversify properly in retirement, and they end up in a business, operating a business that they never thought they wanted to operate, or they've made a single big investment in an area that they thought they had competency in and they didn't, and it's taken a real hit to their retirement plans, and in some cases they've had to go back to work. So for people who are in that transition, I would really encourage them to be patient when it comes to trying to do something on the next step if you want another career after retirement. And then also be very careful in your allocations and keeping, if you want to do something different other than what you've been doing professionally, keeping those allocations small, especially initially until you gain the competency, because there's not a lot of opportunities for people who have left one career and it's really hard to get back in. And it's hard to rebuild that wealth if you've had that from a prior career that's allowed you to retire in the first place. So just stay diversified. And that's when you really have to protect against losses. You have to do that when you're in the markets and professionally trading and professionally investing, but you also have to do that when you retire. And just the consequences I've seen have not been good.
Cool. Well, look, people to find what you're doing today, where to learn more. I know you do a lot of cool stuff on, again, Forbes and, LinkedIn. I read your work and it's all good stuff. So if you don't follow them, but, outside of LinkedIn and I guess, Forbes articles, where can people find more? Is that the main places?
Yeah, look, I think that's the Forbes is the main place of where I post most of my articles. I occasionally post on other platforms, LinkedIn especially, but Forbes and LinkedIn are where I put all my work on. I think that's the audience that wants to read it, and that's the easiest place to find it.
Cool. Well, Garth, we finally did it. We got on here.
It's too long.
Great discussion here. Obviously, you're right down the road to some degree. I'm in Miami, you're in Boca, but you're at, everywhere now. You're the retired, trader, let's say. But anyways, hope to have you in Miami. If I go to Boca, make sure, we grab a bite together. And, again, appreciate you coming on today.
Yeah, sounds good. Thanks, Sean. Thanks for having me.